Hi, I'm Kraig Klaus, and this is State 48 Homeowner.
Hey everybody, and welcome to the State 48 Homeowner Podcast, and this is our July 2023 market update for the Arizona market. How you doing, Kraig?
Incredibly great.
Steve?
I am fantastic. How are you doing, man?
I'm groovy.
Right on.
So it is the heat of summer.
Yes.
We're just kind of rolling off of a long 4th of July weekend and starting to see what the market is doing. And that's one of the interesting things about our market is we see two drops year after year, one in November and December on just the number of transactions going under contract, and then July 4th weekend.
Yeah, it's typically middle of July through August, especially out here. School starts and, summer's over, vacations are over, time to get back to the real world. And so, yeah,
we'll see an uptick. It's not like July is always low. It's just that one weekend is always a drop.
Yep.
Yeah. So what are you saying, Kraig?
Yeah, well, let's get the kind of market update data out of the way. Overall, closings were down 19% in June compared to last year, and down 7% from the year or month before. And that's just closings, because we'll talk a little bit more about that. The median sales price down 3% over year, but up 1.5% from last month. That's 5 months in a row now. The median sales price has risen, is up 7.1 from the low point of the year, in the beginning of the year. The resale market shows prices are continuing to recover, but remain lower than a year ago. Transaction counts will remain very weak, especially for resale homes, hampered by lack of supply and demand. Overall, transaction volume is down almost 20%. And I'm going to be careful when I say transaction volume. That means the number of homes closing. It does not mean prices. It does not mean anything else. The big winners right now are builders. New construction sales are up 7%.
And we need it.
Yeah, 100%. I mean, we're so far under inventoried in what we need, and a lot of people are turning to new because right now they're offering incentives, builder lender incentives for rate buy downs, things like that, and just the availability. And it's just you can go pick out what you want as opposed to settling in resale. So
that's the thing. That's a huge thing is that you can go pick out what you want versus going, okay, of the limited inventory out there, I guess I'll have this one.
and that's it. So, and nationally, in June, the number of homes being listed for sale declined by 25% compared to last year, and we're nearly 20% below pre-pandemic levels of new listings coming to market. And so, and part of that's going to be what we'll lead into is kind of that recent data indicated nearly 82% of home shoppers reported feeling locked in by their existing low mortgage, which we've talked about. 1 in 7 homeowners without a selling plan cited their current low rate as the reason for remaining on the sidelines. There's a currently critical shortage of home for sale. 92% of homeowners with mortgages have rates below 6%. 62% enjoy a rate below 4%, and almost 24% have it below 3%. Interest rate increases over the past few weeks have taken a toll on buyer demand, as we know. For a home buyer taking out a $400,000 mortgage, the monthly payment, principal and interest, rose $83 in a week.
Wow.
And so that's a big part of it. Mark Fleming, chief economist, First American, noted that the history has shown higher rates take the steam out of rising prices, but it doesn't cause them to collapse. This is especially true in today's market where demand for homes continue to outpace supply, keeping upward pressure on prices, which is what we're seeing. It's what we've seen all the beginning of this year. I will say over the last 3 to 4 weeks, we're seeing that slow somewhat, and prices are slowing the increase somewhat. We were at 2.2%, I think, from May to June increase, 1.5% this last month. And inventory is not falling to the level it had been. It's a little slower. I noticed this week. I was convinced we were going to fall below 11,000 by tomorrow. I don't think we will this time, and that'd be active listings. Again, we were almost 22,000 in October, so give you an idea. So I think a lot of this is going to lead into this week is a big week, it sounds like. And then obviously I think it's next week or the week after when they meet, the end of the month?
July 26th.
Yep. So
July 26th, yeah.
I think that's going to be a big part of it. We've got some stuff we'll cover. I'll let Steve kind of talk a little bit about rates, but we've got some stuff. There's going to be some headlines coming out this week on banks reporting losses and defaults and things. We'll talk a little bit about the foreclosures and things like that. But go ahead, tell us what's going on with in your world with rates right now.
Well, mortgage interest rates, unfortunately we're about 2 weeks into the month of July so far, and we've had average 30-year fixed rate is over 7% again.
Yep.
We've kind of popped up, and a lot of that is due to the fact that there were some very favorable jobs data reports from the BLS jobs report, from ADP. They're a little skewed, but again, when that comes out, that causes bond investors to react, and that forces that 10-year treasury yield. You'll see that pop, which obviously those 30-year fixed rates and long-term fixed rates kind of follow that trend a little bit. So that's where we've seen the interest rates pop up over 7. I mean, we were at 7.22% on the average 30-year fixed rate by the end of the 4th of July week, July 7th. Still today, with some improvement in the early part of the second week of July, we're still holding over 7. That leads me to believe that banks and people that issue 30-year fixed rates are just not believing yet. They want to see what's going to happen with the consumer inflation report, which comes out on July 12th, the producer price index report, the wholesale inflation report, which comes out, July 13th, to see if we're still trending in that direction of lower inflation, which we are. I mean, right now, the expectation is that consumer inflation will continue to come down. We'll probably be currently at 4% consumer inflation report. After July 12th report, it should drop to about 3%. Maybe 3.1% is the expectation. That's a pretty significant drop.
Yeah.
And if you think 12 months ago, June of 2022, we peaked at 9.1% for the consumer inflation report. That's a pretty significant drop. But on the other side of things,
they're not done breaking things, though.
They're not done breaking things yet. And the producer price index, or the wholesale inflation, what manufacturers pay for goods, which obviously they pass on a lot of times, that's probably going to drop to 1% or less. And that's come down from 11%.
And that's supply chain and things that have improved.
All of that where the cost for manufacturers to create these goods is dropped dramatically. The consumer inflation has dropped dramatically. So people are like, so why aren't rates moving lower yet? Why are they just not dropping? And it's really because that core inflation. So when the Fed looks at consumer inflation and they strip out food and energy, which they consider to be the most volatile, it's still going down. The trend is just not those significant leaps. It's going down by 0.3 or 0.4 or 0.5, or a half percentage point. They don't think that's significant enough. And then you couple that with the good jobs data, it's leading everyone to believe that the Fed is going to just kind of hold tight on this fight for inflation. July 26th, the Fed meeting you referred to, they're most likely going to raise another 0.25 point to the Federal Reserve rate, in their fight against inflation. And we talked, off air, if that's what we want to say, is that, they're going to raise that 0.25 point. I think they will, because as we talked off air, they don't have a meeting in August.
Right.
Their next one isn't until September. So they're going to kind of just hedge their bet and say, okay, better safe than sorry. Let's raise another quarter. We don't have another meeting till September, and we'll just let the market do what the market does.
This video is brought to you by Klaus Team Real Estate Solutions. The Klaus Team is different. With the Klaus Team, you have someone on your side. Where you live and make memories is important. We have more unique strategies than anyone else to help you accomplish what matters most to you. We can help you with traditional real estate as well as other options such as our lease purchase programs. We can help you buy first then sell, and we can bring you instant offers. We're here to help our neighbors achieve the American dream and help them build wealth through home ownership. For more info or to start your home search, visit us online at klausteam.com.
Let's talk a little bit about the headlines coming out this week. There was an article that I think we all flagged yesterday and saw that U.S. banks are set to report their biggest jump in loan losses since the beginning of the pandemic.
Yeah.
And Bloomberg estimates that Chase, Bank of America, Citigroup, Wells, Goldman, and Morgan Stanley will write off a combined $5 billion tied to default loans in the second quarter. Understand They're going to have their earnings report in the next week or so. This has very little to do with residential housing market. The main types of loans that are going into default when you get into it are credit cards. And
credit cards are number one.
Right.
Yeah.
And commercial.
So when you say loans is hard because they're lumped
Everybody
all that
assumes
debt.
that, yep.
It's debt. It's bank issued debt, whether it be commercial, consumer, small business loans, those types of things. And so when the loan is what's going to scare people because that's what's in the headline.
Correct.
Yep.
So, number one is credit card. I didn't mean to interrupt you. But
you're
credit card
100%.
debt's number one.
Yep. Yeah, and that's credit card, commercial real estate, car loans, things that people get behind on first. And honestly, most people, as I mentioned earlier, in such a low interest rate that their mortgage payment isn't to the level they've been paying that. They're used to that. It's there. It's the ones that are adjusting credit card rates and that are going up. So we can kind of talk a little bit more in that, but about foreclosures, because I know, again, that's still going to be a thing. As of July 1st in the Phoenix market, we had 939 foreclosures pending. Foreclosures pending have been declined for 3 months and are back to the level we saw this time last year. In 2009, for context, we exceeded 50,000 pending foreclosures. So basically, right now, trustee sale to third parties are down 47%. Now, if you want to go on highlight numbers, REO sales, bank-owned sales are up 330%, but that's from 3 to 13.
Yeah, okay.
So,
and again, and we brought up this point before when we talked about this. Even if we did see an increase,
they'd be gone.
The market would.
It wouldn't affect. It wouldn't
absolutely.
It wouldn't impact pricing. Not in a negative way. Black Knight reported on June 23rd. Serious delinquencies, 90 days past due or more, continue to improve nationally, falling by almost 4% from April. Now, so basically, there's less than just over 200,000 loans currently over 90 days late, and basically comparable to 2019, the national average delinquency rate in May was 3.1%, returning to near record lows. Median credit score right now for people taking out a mortgage is 765.
Yeah.
So, again, going back to that, just not a lot of data to support any of that stuff.
What's that?
That there's going to be foreclosures, that banks are having issues with residential mortgage loans and things like that.
And let's go back to if they did come to market, let's say we had 50 come to the market tomorrow. Right now, for affordable inventory, under 500,000 in Mesa, Gilbert, Chandler, and Queen Creek, for single family and condos, we have 1,062 total, but under 500,000 is 338. So if we had 50 come to market,
You could have 500 come to market.
yeah, but they generally are distressed. If people are losing their home, they probably didn't take that great care of it, especially at the end when they're mad at the bank. And so if those came to market, it would just make the other one shine brighter.
Correct.
Right.
Well, and
they still would sell.
Well, and banks
Still would
learned
sell,
towards the end of, the early 12, 13, 14, 15 range that they sold better if they just cleaned them up a little bit. And they've got the buying power, their ability to do that. So, they're not going to be upgraded.
Right now,
right.
the flippers are hungry.
100%.
Yeah, right.
The flippers can't get properties to...
No, wholesalers and institutional buyer activity is way down.
Yeah, because actual buyers are willing to pay the market value.
Yeah. It's going to be, again, we talked about it internally here as a team, it's going to be a slow summer in terms of just overall activity. Again, don't expect anything negative in price appreciation. I think it's going to slow for the next month or two. Again, we get good news. Rates drop into the mid sixes or low sixes again. Things will go. If they hit a 5 in front of them, like we've been saying for a long time, I mean, it's gonna be like a pandemic level type run just from where we're at, from up to almost 22,000. We went from 4,400 in April of 22 active homes on the market up to almost 22,000 in October. So however many months, 7 months or whatever, and now we're back down to 11,000. And so you can see how quickly that can change. And if we're at 11 or 12,000 and rates drop 1% or something like that, it's gonna go crazy again.
Well, and as I mentioned last time in our previous podcast, is looking back at the data, every time there's been a movement lower, nothing with a 5 yet.
Yeah.
I mean, just even into the 6s, the 6.5, 6 1/4, 6 3/8. we've seen uptick in mortgage applications and activity in transactions. So yes, it's there. So I agree with you completely.
And it's just consistency. You know, even if they drop to 6.5, but just stay there. People adjust and get used to it and understand it. Plus, now that they've seen them higher, they understand that. We saw it at the end of last year, or in the summer of last year, when they started, you know, from 3 to 4 to 5, and then by the time they got to 5.5 in May, everybody's like, "Oh, that's too high. We're not buying." Then they got up to 7. And then August, they fell back down in 5s, and it went crazy again. All of a sudden, 5 was good. And just like now, right now, people would kill to have 5.
Yeah, absolutely.
That are looking to buy right now.
That are looking to buy right now. Absolutely.
So is there a shortage of people moving to Arizona?
Never.
No.
No, I mean, we're number one and still in relocations, and that's what drives a lot of our buyer traffic right now, and first-time buyers. Because, again, as we talked about, if you're a move-up buyer, downsizing, this is hard to do right now from a business standpoint.
Sure, but those first-time home buyers, you know, they're moving from 100%
100% to 7 isn't bad.
Sure. And out-of-state buyers, I mean, the migration to Phoenix is what's still number one.
Number one, and then the Carolinas, then Tennessee, and then Texas.
Yep. Yeah.
So Arizona's number one according to Allied Moving,
and that'll help drive that demand, continued demand for housing, because if that many people continuing to move to the Phoenix area over, you know, on a month-end basis, what is it, 250 still?
Almost 300, yeah.
Almost 300 now.
In new construction, they can't build fast enough again. They're trying like crazy to ramp up and get building again to try to satisfy that demand. So
and to get land to build on.
Correct.
You know, fortunately, we're seeing some new developments, Superstition Vistas, that kind of has just a lot of land to work with. But for people, you know, Gilbert is almost landlocked. Chandler's almost landlocked. And so there's a lot of infill neighborhoods, but real shortage on larger master plan. There's a new one coming in Chandler, down at Val Vista and on the highway. The Earnhardts finally selling their ranch.
Yep, that's right. Texas finally gets selling it. Yeah.
And because he passed away a couple years ago. And they've been working on
Blanford
that. Blanford's doing that one.
Mm-hmm.
But it's not huge. You know, when we talk about master plan communities, we're thinking about Eastmark, Seville, Augusta Ranch,
even almost like a square mile, even like Augusta's a square mile. You know, Mesquite Center are half square miles.
But we're to the point where in these cities that is a good chunk of land, and we're running out of those opportunities.
Yeah, if you even
especially in Chandler, and now Gilbert.
If you could find land like that in Tempe right now to build, I mean, that's because Tempe's been landlocked forever, and that's the one.
And that's what drives the price.
100%.
I mean, if you go on the 101 and go one side of the freeway to the other, there's a huge price difference for the same age house just because it has a Tempe zip code.
Correct. Absolutely. Yeah, it's going to be an interesting next couple months. Again, I think overall, if you're a homeowner, it's good. Price appreciation is going to either increase or remain. And if you're a buyer, this is the time because we see relief in rates. It's going to get crazy, and you're going to be back to competing with everybody else.
Well, even with the volatility in interest rates, we've still seen price appreciation. We've still 100%. Seen home value appreciation so far year to date.
Because of inventory.
I mean, the two home appreciation reports that came out July 11th, both of them, Black Knight and CoreLogic, who are the top two for home appreciation and values, not just price, because, you know, median price is a little bit different than appreciation. But Black Knight, right now, they're on pace for 5 to 6% appreciation across the U.S. in home values for the year. CoreLogic is darn near 10% appreciation in 2023. So, again, we didn't lose 20% in value. We didn't have a foreclosure wave. Instead, we've gone at a slower pace, more methodical pace, which could obviously hasten if we get an interest rate improvement, pretty dramatic one, especially in markets like Phoenix.
Well, and a lot of the country now is made up their losses from the second half of last year. We haven't quite. We're obviously getting closer, but we're also the highest gain. So we're going to be, our fall is going to be a little bit more, and take a little longer to come back. But overall, I think we're on pace to make up anything that we lost the second half of last year and then some.
Steady or slow improvement is always good.
100%. We haven't had that. It's always been one or the other lately.
So as we get ready to head out here, Kraig, when you're working with sellers and you've got buyers on the other side, who's holding the cards right now?
Sellers have the upper hand in most situations just due to lack of supply. Again, it's the idea of, well, I don't want to pay that. Okay, we'll go buy the same house down the street for less. Well, it's not there.
Right.
Yep.
So that sellers still have the upper hand. But buyers are, it's not the pandemic level buying right now where you're begging them to take your offer and you're saying, I'll pay you to not do an inspection and I'll feed your kids for the next year or whatever. I mean, you have some leverage and there are still concessions and home warranties and things like that. But the idea that, well, it's been on the market 14 days, we're going to offer 10% less, that's not going to happen.
Yeah.
No.
Well, thank you guys. Appreciate it.
Absolutely.
Thank you, Scott.
Thank you.
Thanks for spending time with us this week at State 48 Homeowner, the ins and outs of owning an Arizona home. You can connect with us for more information, submit topics you'd like us to discuss further, and you can see relevant videos, give us feedback, answer your real estate questions, and more at state48homeowner.com.